After a slow start, the Dow gave a clear message that not only was the 200-day moving average not going to act as resistance, it actually showed they were going to use it for support, kind of giving more credibility to the upside. It's broken the downtrend when it came through the 200, and it got there. Notice how when they gapped this up, they gapped it up right into the 200. Logic says if they're gapping it up and trading toward a resistance level, they probably don't have that much concern about the resistance level anymore. They wouldn't be gapping it up to get there. The uptrend continues, with further evidence being illustrated by the NASDAQ. Notice the NASDAQ did a little kicker type signal off the T-line, broke out through this resistance level, and kind of did a doji sandwich type day today. A doji sandwich, a big bullish day, a doji, and then trading positive on the open after a doji, which the doji rule is the price will usually move in the direction of how they open after a doji, continuing to make the 200-day moving average the likely target. Knowing that the market was not reversing or heading down allows the candlestick investor to take advantage of very high probability candlestick patterns. You could see the kind of the rounding bottom, scoop type pattern setting up in our recommendation of IOVA. We recommended it on Friday, and it did a doji day, which still told us that if it opened positive today, we had essentially a doji sandwich, meaning this candle right here and this candle right here was going to be somewhat the same magnitude with the doji sandwiched in between. If you add the fact that we had kind of a morning star signal at this level, bringing us back up through the T-line, creating the uptrend, the morning star signal followed by a doji sandwich, we call a McMuffin, which is basically a morning sandwich. Both have implied results. First of all, an evening or a morning star signal in candlestick analysis is one of the 12 major signals, and it implies there's going to be more upside. A doji sandwich shows that there's a high probability positive trading, which also implies more upside. So when you add the two together, this becomes a very high probability uptrend. The doji sandwich being applied to the NVIDIA chart also shows a big uptrend after a hammer type signal, then the doji, and then the simple doji rule. They're going to trade it in the direction of how they open after a doji, implying a doji sandwich, meaning if the magnitude of the next move is the same as this move, that the 50 and possibly the 34 are not going to act as resistance, and it implies there's going to be more upside. So now we can make an analysis that stochastics turning back up, you have a doji sandwich breaking through the 50. Where's the next likely target? Probably the existing trend that started before the big pullback. Will it get there? Doesn't mean it will get there, but the probabilities are pretty strong that this pattern setup is going to create a move back up to get into the trend, which allows the candlestick investor to make high probability investment trade setups. And the trading pattern setting up in Netflix is also demonstrated that this is wave one, this is the J-hook pattern setup, and notice how the trading occurred today after an inverted hammer signal that was sitting right on the T-line. The inverted hammer signal, one of the 12 major signals, says if you open positive, the probabilities of the next move to the upside is going to be 95% or better to the upside. This allows us to take advantage of high probability trade setups, knowing that our uptrend's in progress and we can measure what the magnitude of the next move might be. That'll be it. We'll see you in the chat rooms.